Good morning. It's 5 a.m. in New York. I'm Matt Miller in for Danny Berger with your Bloomberg brief. Here's what you need to know. Stock futures dip as trade uncertainties linger, and the OECD slashes its global economic forecast, citing President Trump's tariffs. The president presses on Republican holdouts to back his multi-trillion-dollar tax bill as senators return to Capitol Hill, and Microsoft cuts more than 300 jobs in addition to the company's largest layoffs last month. Let's take a look at what's going on in futures at this hour. As I said, we have a little bit of a dip here. S&P futures down 0.5% right now. You can see NASDAQ 100 futures also down just a little bit less than that. This after we finished the day yesterday in the green. So at least a positive kickoff to the month. In terms of what we're seeing in treasuries, the all-important bond levels here are being bought. So you're seeing the yields come down. The U.S. 2-year yield at 3.92, the 10-year yield at 4.41, and the 30-year at 4.93. So backing off that so-called danger zone. We're getting some breaking economic news right now in terms of CPIs for the euro area. You can see here that we got preliminary May CPI. Looks like the CPI month over month was a gain of 0.4%, year over year 3.5%. And in terms of the core year over year number, 2.3%. The Eurozone CPI is then coming in, and you can see the euro dollar right now at 1.14. Let's get some more on in terms of the market this morning, the stocks that you need to be watching on both sides of the Atlantic. For that, we go to Joe Easton in London. Joe, what have you got?
Morning, Matt. So we are looking at Microsoft. As you mentioned there, we are seeing more job cuts at the tech company, potentially around 300 more layoffs following those thousands of layoffs that we heard of just a few weeks ago. Microsoft recently hitting or approaching at least a closing record high, but coming down very slightly today. We're down 0.3% at the moment. Then we've got a big mover in the pharma space. It is a Swiss-based company that does actually trade in New York. This is being taken over by Merck, which we have on the screen here. We're down 0.2%. Merck potentially going to be taking over Moonlake Immunotherapies, which makes some skin drugs, and actually it's worth a few $1 billion. That stock was rising around 20% in the pre-market, but Merck itself actually slipping very slightly, given that news flow, that report out of the Financial Times. Then finally, in the online dating space, a bit of a move to the downside. Bumble hit today. We're down 5.5% on this one. Gen Z not doing enough dating online. Now, I think they prefer the IRL in real life dating, according to JPM. So JPM cuts the stock to underweight, says the price target needs to come down, and also potentially the new users and new additions in the next quarter are going to disappoint. And as usual, take a look at the before the bell opening wrap for a wrap up of all these news, movers and more. Back to you, Matt.
Always read that at 5:30 a.m. New York time. Joe, thanks very much for that. Now, in just moments, we're going to speak with Paul Donovan, the chief economist at UBS. And then later this hour, we're going to get J.P. Morgan's Kelsey Berro joining us to discuss the labor market. I want to take a quick moment to correct the CPI numbers that I read on air, because you saw the correct headlines on the Chiron, but I, for some reason, have Croatia plugged into my terminal. So it wasn't 0.4% and 3.5%. Month over month, the CPI was unchanged for the Eurozone specifically, and the core year over year number was a gain of 2.3%. 2.3%. The expectation was 2.4%. So much more in line with expectations there. Don't miss, by the way, our exclusive conversation. You must have seen just now her picture. U.S. Secretary of Agriculture Brooke Rollins joins us on trade negotiations around food and crops. That's at 5:30 a.m. New York time, as we also watch to see how much the government allows ethanol to be put into our gasoline. We'll ask her about that as well. Now, the OECD has slashed its global economic forecast for the second time this year, with the U.S. being hit the hardest, citing President Trump's trade policy. It now forecasts U.S. economic growth to slow to 1.6% this year, down from a previous projection of 2.2%. Joining us now is Paul Donovan, chief economist at UBS Global Wealth Management. Paul, great to have you on the program. I wonder what your take is on the slowing growth picture in the U.S., as well as expectations for increased inflation here and a much more divergent decrease in the Eurozone. I just read a 0.0% month-over-month figure for CPI.
With the United States, obviously, we've got a fairly substantial tax increase. That's what the tariff amounts to, and it's a tax which is paid ultimately by the US consumer. We've got 4,000 years worth of history of how trade taxes work. The consumer ends up paying. So it's not surprising, I think, in the face of such a significant tax increase that we are then going to be seeing a slowdown in the economy. And on top of that, we have the effects of the uncertainty caused by the rather wild swings in policy that we have, not just on trade policy, although that, of course, is something where President Trump announces something and then retreats and then announces and retreats, but also on fiscal policy, where there is considerable uncertainty. And that's weighing on firms' willingness to commit investments, to commit to hiring, and that is going to slow down. But the pattern that we see in the States is likely to be, first you get the inflation hit. That's going to be the first thing that comes through. And then subsequently you get the growth slow down as consumers go from rising real incomes to falling real incomes as a consequence of these trade taxes.
So do you think we see a bigger slowdown then in 2026, Paul? Because 1.6% in 2025 doesn't seem as bad as we may have feared on April 2nd.
Well, bear in mind, what we're talking about here are annual average numbers. And the way that this works means that the boost to the economy in 2024, which pushed up growth, means that when we compare the average of this year to the average of last year, you're going to struggle to get a number below 1%, let's put it that way, in terms of the annual average growth rate. So some of this is just sort of a statistical sleight of hand. If we look at the momentum in the second half of this year, then I think we're probably looking at a fairly soft momentum in the US economy. Not so much elsewhere, but in the United States, you've got that softness as a consequence of the first round shock, the inflation shock, and then the second round effects, the uncertainty, the impacts on hiring that come out of the current policy stance.
What are the effects then on global growth of these tariffs, Paul? Because, if it's just a tax and we trade taxes on tips and Social Security for taxes on goods bought, yes, it may be regressive, but we're still getting that revenue. It's no big deal. Do you see then, though, a slowdown in growth in other countries because maybe Americans don't want to pay that tax?
Well, so this is where things start to get a lot more complicated. The first point, which we need to stress, this is not the 1930s. In the 1930s, everybody was fighting everybody else. Everyone was putting tariffs on everyone else. That's not what is happening here. This is the United States versus the rest of the world. The UK is trading very happily, in fact, more happily, with Europe. Europe is trading with China. China is trading with Japan, etc., etc. So this is something which is US specific, and that blunts the impact elsewhere. The second thing is, what is the reaction of US companies to the tariffs? And that does make a big difference, because US companies have a choice. They could go for market share, keep their prices unchanged, try and take market share from their competitors. And that, of course, would be very negative for exporters in the rest of the world. But if US companies say, actually, you know what, we're not going to go for market share, we're going to go for profit margin, we're going to raise our prices under the cover of these tariffs, then that means that whilst a slowing US consumer does do damage to rest of world exporters, that damage is more muted because the rest of the world still maintain their market share. Now, I suspect that we're going to be erring towards that scenario. US companies do raise prices as tariffs come in. They don't go for the market share so much, and that means, again, that the impact on the rest of the world is a little bit blunted. Obviously, We're seeing rate cuts in many other countries around the world because they're in a disinflation environment at the moment, which the United States is not. We've also got more room for fiscal maneuver in the rest of the world. We don't have these enormous deficits that the United States has got. Again, that provides a degree of support.
Paul, great to get your take on this stuff. Obviously very complicated, so really great explainer there. Paul Donovan of UBS Global Wealth Management giving us a little education this morning. Let's get to some of the other top stories trending on the terminal. Far-right lawmaker Geert Wilders pulls his Freedom Party out of the Netherlands ruling coalition, causing a collapse of the Dutch government. That exit triggers an election which would otherwise have been held in 2027. China's manufacturing sector had its worst slump since September 2022, falling to 48.3 in May from a reading of 50.4 in the prior month. The figure was below every estimate in a Bloomberg survey of analysts. It came as higher tariffs took a toll on smaller exporters, despite a truce in the trade war with the U.S., although that looks like it's been unraveling. Elon Musk is selling $5 billion in debt for his startup XAI. It's the latest in a series of fundraising events across his business empire as he pivots away from politics. Sources say the package includes a floating rate term loan, a fixed rate term loan, and senior secured notes with proceeds going towards general corporate purposes. Coming up, the White House pushes for a Trump-Xi call while Secretary Lutnick shows optimism for a deal with India. More on trade talks next. This is Bloomberg.
Trump wants to talk at the very highest levels. That's not always how the Chinese want to do business, and I'd be curious to see if they're able to make any headway. Trump doesn't want to go through the back channels. He doesn't want to go through the ordinary course of business. That's never been his style as a leader, being in business or in his first term in office. He wants to talk to the principal. He wants to talk to President Xi himself. So we'll be curious to see if the conversations that the White House has telegraphed actually do take place.
That was President Trump's former White House acting chief of staff, Mick Mulvaney, speaking to Bloomberg Television earlier. Simmering trade tensions between the U.S. and China seem to be at an impasse ahead of a potential phone call between President Trump and his counterpart, President Xi, if that even happens. For more on trade, we're joined by Bloomberg's global trade editor, Brendan Murray. And Brendan, I guess my first question would be, how likely is this call to happen? Because President Trump has been asking for it, as have his cabinet members, for months now, and Xi continues to demur.
Yeah, exactly. There's a real clash of culture here when it comes to trade negotiations. As Mick Mulvaney was saying, the Chinese want to do a lot of back channeling. They want to have some deliverables that both leaders can announce after a call like this, rather than the leaders meeting and setting the tone for a series of conversations. So it would appear that the Chinese are digging in their heels here, and the U.S. side, the White House, the officials we've heard from in the past 48 hours are really pushing for this call to happen. But they seem to be that message seems to be falling on deaf ears so far. The Chinese will want some sort of concessions to the tariffs that the president has in place, but the Trump doesn't seem to be ready to budge much on his side either. So it is a real a chess match here that's at a stalemate.
Right. I mean, one side is begging for a phone call and the other side isn't. So that kind of shows you how the balance of power shakes out. What do we know about the deal that Scott Bessent and his Chinese counterparts negotiated in Geneva? Is that deal still holding, or is that done?
Well, both sides are pointing fingers at each other, saying you haven't lived up to your end of the bargain on that. That was 3 weeks ago. The U.S. wants China to sort of unlock the control it has over critical minerals, things like magnets and other sort of things that are needed for advanced technology. China wants the U.S. to ease up on export controls of high-tech equipment like semiconductors, and so both seem to be pointing a finger at each other and saying, hey, you said you do this, but you're not doing it. And so that deal, while it doesn't look to be holding at the moment, it isn't broken just yet, but it seems to be very fragile. And the tone, the move, the impetus seems to be moving toward escalation as opposed to de-escalation, at least in the rhetoric.
All right, Brendan, thanks very much. Brendan Murray is Bloomberg's global trade editor. Now let's get to the domestic front. President Trump working the phones to try and sway his party's Senate holdouts to back his one big, beautiful, multi-trillion-dollar tax bill. He's also posted on Truth Social, calling on Senate House Republicans to, quote, work as fast as they can to get this bill to my desk before the 4th of July. Bloomberg's Josh Galou joins us now for more. Josh, what do we know about the holdouts? I mean, I'm guessing these are Republicans in states that would normally be getting a lot of, for example, clean energy subsidies, or Republicans in states that are going to see hundreds of thousands, if not millions, cut from the Medicaid rolls. So how do you sway those kind of politicians?
Yeah, that's exactly right. I think there's a clear playbook for the White House when it comes to the Medicaid cuts. They're trying to sell the idea that they're really diminishing the pool of people that are going to access Medicaid rather than cutting actual benefits, by disallowing undocumented immigrants or other people who they say are able-bodied and able to work. So having that work requirement. Whether or not people go for that is an open question. Josh Hawley, of course, of Missouri, is one of the biggest holdouts on Medicaid. And he said that Trump has assured him there won't be any cuts to actual benefits, which seems to work for him. We'll see if it works for others. But whether that's enough to satisfy the fiscal hawks is another question, because the House bill, at least, is meant to add $3 to $5 trillion to the debt over time, over the 10-year period. And, you have Ron Johnson, you have Rand Paul, you have Mike Lee and others who are really pushing for deeper cuts. And where you're going to find those is tough to see. And as you pointed out, clean energy is one of the big ones. But you have people like Tom Tillis, Collins, Murkowski, that, they have enough support that if they really are willing to block the bill for that, they can, because Trump can really only afford to lose 3 votes in the Senate. So
having said that, Josh, why is no one concerned that this bill doesn't pass? Is it just that changes need to be made, but eventually we're all confident it gets over the line?
Well, I think there's a lot of confidence that it's going to get over the line. Whether it happens on Trump's timeline is another question, because, the things that the Senate is talking about are also very different from what the House wants. The House, it barely squeaked by in the House. And the Senate, for instance, one of the sticking points for the House was the state and local tax deduction. And that's driven by high-tax states like California, New Jersey, New York. In the House, there are Republican representatives who wanted that the cap to be raised. But in the Senate, they don't care as much. The people from the senators from those states that care about SALT are Democrats. So it's an entirely different calculation right now, and they don't need those people to come along with them for this vote. Whether it gets, Tillis says that they're going to have a draft to Trump by this weekend. That seems ambitious given all of the discrepancies that are still out there. But it still seems like a pretty long and patchy road ahead.
So what you're saying is there's a chance that the state and local tax deduction, already capped by President Trump in 2017, is going to stay capped, possibly at a lower level than the House has negotiated.
It's certainly possible. I think the House negotiated it up to $40,000 and from $10,000 after it had been uncapped before, and the Senate is talking about a compromise there.
Josh, thanks so much for joining us. Josh Galoo there talking to us about the one big, beautiful bill. Coming up, tensions escalating in the war between Russia and Ukraine. More in your front page news next. This is Bloomberg. Time now for our front page news, a look at what's making headlines around the world. First up, the Wall Street Journal leads with the escalation of the Russia-Ukraine war. Despite saying they want peace, this follows the weekend's drone attacks in Russia. The two sides met for a second round of talks in Istanbul, but the meeting lasted barely an hour, producing only an agreement to exchange prisoners, nothing more. Next up, on the FT, the Polish government is bracing for a confidence vote on Donald Tusk. After a bruising defeat in the recent presidential race, Tusk aims to reestablish unity in the cabinet and has an emergency plan in case of difficult cooperation with the new ultra-conservative president. And on the New York Times, more details have emerged on the suspect in the weekend attack in Boulder, Colorado. The suspect came to the U.S. in 2022 and lived with his family in a suburban neighborhood. He told police he disguised himself as a gardener when he headed towards members of a Jewish group walking downtown before attacking them with incendiary devices. Coming up, we'll take a closer look at food standards and trade. Good morning. It's 5:30 a.m. in New York City. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock futures dip as trade uncertainties linger, and the OECD slashes its global economic forecast, citing President Trump's tariffs. The president presses on Republican holdouts to back his multi-trillion-dollar tax bill as senators return to Capitol Hill. And Microsoft cuts more than 300 jobs in addition to the company's largest layoffs last month. In terms of the indexes, futures are down, but we did finish in the green yesterday, even with a red start to the trade. The S&P 500 closed up 0.4 to 59.35. You can see S&P futures now down about 0.4 or 0.5%. NASDAQ futures down 0.4 and Russell 2000 futures falling as well. Treasuries have been all important for this market, but look relatively tame today. U.S. two-year yield coming down almost 2 basis points to 3.92. The 10-year yield coming down more than 2 to 4.41, 4.42, and the U.S. 30-year yield trading well under 5% at 4.9428. For some of the stocks to watch this morning, let's get over to Joe Easton in London. Joe, what do you got?
Hey, Matt, so Microsoft in the radar once again. We are seeing that stock slipping only by around 0.3%. Remember, we got news of the company laying off around 300 workers. This is according to a state filing seen by Bloomberg, and does come just a couple of weeks after we saw around 6,000 layoffs at the company, the biggest layoffs in years at the firm. Keep an eye on that one in pre-market. Then I've got UBS on my radar. Now, UBS has a big ruling coming up on Friday from the Swiss government around how much capital they need to have on their books following that big takeover of Credit Suisse that we saw a couple of years ago. Now, analysts at Jefferies saying there is too much fear heading into that report from the Swiss government, and they upgrade the stock to buy this morning, and therefore we're seeing the shares gaining around 2.5% for UBS in the pre-market. And then a different kind of broker move, this over in the online dating space. J.P. Morgan downgrading Bumble today, and that stock falling almost 6%. JPM saying that the Gen Z users are cutting back on their online dating. I think Gen Z needs to be a bit more romantic to help this stock out, but we're seeing it down 6% at the moment. JPM reckons they will see a drop-off in their active users when Bumble next reports its quarterly updates. So that broker move really hitting the stock today, Matt. Bumble declining almost 6% in pre-market trading this morning.
There's nothing you and I can do about it, Joe, because you know how Bumble works, right?
We're well past that, I think, in terms of the Gen Z element, at least.
Yes. No, I mean, we're too old for sure. But the thing is, the woman has to make the first move on Bumble. That's what differentiates it from
Right.
Tinder
Okay.
or
Yeah.
OkCupid.
I'm well out of line with these data.
Joe,
procedures.
as well, you should be. Joe Easton, get over to your desk and push the button on Before the Bell. Before the Bell is Joe's newsletter. Highly recommend checking it out. Comes out every day, New York time at 5:30 a.m. and really sets you up well for the trade. One sector at the center of the U.S.'s recalibration of trade is agriculture. Washington has been lobbied by farmers who've lost their biggest export market due to the tariff battle between the U.S. and China. Trading partners, particularly China, have also had to readjust their food and farming industries as they navigate a shifting trade landscape. For more, we're joined again by Bloomberg's Brendan Murray, our global trade editor. So, Brendan, this is pretty fascinating and important to the livelihoods of millions of Americans. What do we know about farmers' lost revenue due to the trade war?
Yeah, well, if you remember during Trump's first administration, he negotiated what he called this Phase 1 agreement with China. And in that agreement was a promise by Beijing to buy $80 billion worth of American agriculture products. Well, that deal went dormant during the Biden administration and remains non-existent today. So with the U.S. and China currently at a stalemate in these trade negotiations and trade between the two countries, that's really fallen a great deal. Farmers who've just planted their soybeans and their corn across the Midwest are looking at this summer going, well, who's going to buy these crops at the end of this? And so you've got the Trump administration trying to do these deals with individual countries. These are tariff deals and deals that address non-tariff barriers like food safety regulations and sanitary standards and those kinds of things. So the Trump administration is looking for other customers for American agriculture exports, and this is going to be a big issue for the farm vote as we head into the next several months. Now, what we understand is that Vietnam is looking to buy some, and there will be other deals between these countries. The Trump administration hopes to make up for that lost market in China. Maybe there'll be a deal with China that restores those purchases. But if for the time being, American farmers are looking out going, look, you've just, you kind of burned a bridge with our biggest, our export customer, and how are we going to replace that demand? So that's what the Trump administration is trying to address.
All right, Brendan, thanks very much. Global trade editor Brendan Murray there setting us up for the secretary. Agriculture at the center of so many of the Trump administration's negotiation. U.S. Agriculture Secretary Brooke Rollins joins us now, where she is in Rome for meetings with Italian counterparts right now. She posted on X yesterday about her mission balancing trade and putting American ag first. I'm pleased to get the secretary on a television with us, Brooke Rollins. Secretary Rollins, thank you so much for joining us. Let me first ask what you've achieved there in Rome, because as we know, exports to Europe and the UK have been important but problematic. They have issues with genetically modified crops. They have issues with the hormone that we use in our beef. They have issues with the chlorine that we use to wash our chicken. So what can we do about those kind of non-trade barriers, and what have you achieved there?
Well, thanks so much for having me on. A couple of quick top lines, and then we'll talk about that. The first thing is this, that the president's vision to realign the world economy around putting America first was long coming. For too long, America has been subject to a tariff regime of other countries, and now that's changing, and it's changing for the better for our country. So I think that's really, really important, and from my perspective, for our farmers and our ranchers. The second thing I think is important is being in Italy today. I was in the UK just a couple of weeks ago. I'll be in Vietnam, Japan, and India next month. That it is time that we move these products and continue to work on the world stage. Last night we had an incredible day, all day yesterday and last night, with my counterparts here in Italy. Their Minister of Agriculture, Lolo Brigida, who is wonderful. We talked about getting more of our soybeans, more of our wheat, more of our great products from America into Italy and, of course, across the EU. But the third thing I'll say, and that is your point, that this concept that American agriculture isn't safe, or the genetically modified, whatever it is, there are thousands of research data compilations that prove that to be wrong. Those are called non-tariff trade barriers, and they are absolutely not real. It's not based in science, and it's time that changed. And I know our trade team from America has been working on that. They continue to work on that. We've got more deals that will be or should be announced in the next week or two, and that non-tariff part of that is a really important part. When people say the chlorinated chicken, only 5% of our chicken in America still uses that chlorine rinse. And even if more used it, it's still considered safe according to worldwide standards, not just American standards. Same on the GMOs, same on the hormones, et cetera. So we feel very confident we have the best product in the world, and we're going to keep moving it out.
Ms. Secretary, the issues that you're raising seem to be some that our own health secretary, Robert F. Kennedy, has with foods. The science clearly notwithstanding, right? He has issues with chemical treatments. He has issues with additives in some of our foods that are very similar to those that the EU and the UK have. Aren't you looking at changes along those lines for U.S. food standards as well?
Secretary Kennedy has been very clear that the American product is safe, and it is really the best. Now, where he comes in is, can we do better? And I think what everyone, everywhere in every product, every lane, it's always about how do we do better? How do we do better? How do we ensure that our products are continually improving? And we're doing that, and that's where he's coming down. But really, as part of the Make America Healthy Again Commission, as the mom of 4 teenagers, a MAHA mom myself, it isn't just, it's more about the ultra-processed foods. It's more about all of the other parts of the environment in America that are making our population as, more unhealthy. Chronic disease, et cetera, is at an all-time high. But this has nothing to do with our soybeans, our wheat, our beef, our seafood, all of the great products that are coming from America. And Secretary Kennedy and I are very close. We've talked about this at length. He's visited farms with me in Texas. We have another couple farms we're going to be visiting in California in the next month. So we are simpatico on this. Now, do we agree on everything? No, but we agree on most things. And I think that the American people under President Trump's vision will be the ultimate beneficiary of that. But also, as we are on the world stage, continuing to move our great farming and ranching products out there. And I know your guest a minute ago talked about China. Listen, we had a great deal with China in 2019. The Biden administration decided not to enforce it. And as a result, we now have a $45 billion trade deficit in our ag products. So that's what we're trying to sort of make up for right now.
I would have thought that RFK Jr. had a real problem with our wheat. I've heard him for years talking about the glyphosate used in pesticides and linking that to non-Hodgkin's lymphoma. So it's interesting, and I look forward to seeing that the two of you together visiting farms. Let's talk about the recalibration of trade. If you lose, say, $2 billion from food aid programs, but gain it in Vietnam, I know that you're headed there and they want to buy $2 billion more of our products. That's fine, I guess, but it takes time to do those things. So in the meantime, we've seen soybean exports drop, I think, 79% below the 5-year average. Corn exports drop 49%. Do you have to make that up with some sort of farmer subsidy program? In the first administration, President Trump gave the farmers $28 billion. Is something similar like that going to happen again this year?
Well, we remain really convicted that we're just at the beginning of these renegotiations, that the market has reacted, but at the end of the day, inflation is down, jobs are up. We continue to see a positive sign. Specific to soybean, corn, really our row croppers, that's really a very direct result of China. And I know we're making progress on China. We'll continue to make progress, hopefully. But if we don't, opening up markets all over the world. Listen, EU, for example, charges a 10% tariff on average on American products, and vice versa, we only charge 5%. That's 2x. The average tariff charge around the world is about 15% on American products, when we charge on average 5%. We've been taken advantage of over and over and over again. So as we are realigning, we're also opening up these markets with the trade deal. The UK just a couple of weeks ago was a massive deal. 25 years we couldn't get a deal done with the UK. And now all of a sudden we have the deal. And that will be extremely beneficial for our corn farmers, our soy farmers through ethanol, and our beef cattle, et cetera. So you'll continue to see this moving forward. Now, if around harvest time, into the summer, beginning of the fall, we see some real economic harm with our farmers, our president has been unequivocal in saying that he's got the farmers back. And if there is short-term consequences, we'll make sure to do everything we can to mitigate that. And I'm here to execute on the president's vision. So yes.
Can I ask about ethanol specifically? I'm from the great state of Ohio. I grew up surrounded by corn farmers, and I have a lot of respect for the work that those farmers do for our country, really for our national security. And it's delicious. But I'm also a fan of the big American V8 motor, and I do not want to put ethanol-based gasoline in my car. I'll drive miles to get premium-grade fuel. It doesn't have any ethanol. What are you thinking about in terms of the level of crop-based biofuels that should go into gasoline?
Well, I think the most important thing to realize is that we've got an energy national security crisis, and that there are many different ways to solve that. And that's what Doug Burgum and Chris Wright, two of my cabinet counterparts, are really focused on. The President Trump, talk about being unequivocal. He's been unequivocal in his support for ethanol and biofuels. And it isn't just about America. And listen, this is the great thing. It's America, where you can choose what you prefer and what you want to put in your vehicle. But the ethanol conversation that's happening around the world, you talk about the UK, which whether we agree or not, I happen to not agree, but their goal is to get to net zero, right? Net zero, which again, we could have a whole other show on that. But in order to get to net zero, they're going to need our biofuels from America to do that. So it isn't just about specific to, what you're going to put in your truck when you drive across Ohio, which there may be some that disagree with that, what you just said. But it's also about where America stands on the world stage. A, how we achieve energy independence, but B, how we continue to support our great farmers and our ranchers. And food security is national security. And I think that's really important. If we don't have a strong agriculture sector, if we can't feed ourselves, we are no longer the superpower in the world. And so all of this, it's a complicated sort of balance that we're striking, that we're working to achieve. But with the president's vision, and I think with arguably one of the greatest cabinets in the history of our country, we will achieve it for the American people by putting America first.
Mr. Secretary, thank you so much for your time. Really appreciate it. U.S. Agriculture Secretary Brooke Rollins in Rome. Coming up, JOLTS data comes out later this morning ahead of the jobs report on Friday. We're going to push ahead with J.P. Morgan's Kelsey Berro next. This is Bloomberg. A host of jobs data coming this week, starting with JOLTS at 10 a.m. today, ADP on Wednesday, jobless claims on Thursday, and the all-important payrolls report on Friday. J.P. Morgan's Kelsey Berro looking ahead to Friday, writing, quote, "We view the labor market as treading water. Companies are not firing workers, but we don't see any reason they should be accelerating hiring either, given elevated trade and policy uncertainty. On the margin, though, Shadow's slack does appear to continue to build." Kelsey joins us now. She is fixed income portfolio manager at J.P. Morgan Asset Management. And we'll get to treasuries, obviously. But I want to ask first about this, not necessarily JOLTS this morning, but just the labor market in general. How does it look to you? Because I'm sure Jay Powell and the Fed have really been weighing which side of their mandate to pay attention to. It doesn't seem like labor is that much of a problem.
Labor is not a problem, but it's not a problem in a few different ways. So the thing that the Fed was concerned about in prior years was that the labor market was a source of inflationary pressure, particularly wages. Now, I think the labor market has rebalanced and continues to rebalance such that we feel fairly confident that labor market isn't a source of inflationary pressure right now, which is why you've seen so much stability in the front end of the Treasury curve. So today, when I look at the JOLTS report, what I'm expecting to see is a continued deceleration in job openings, a continued deceleration in the quits rate. All of these things suggest continued moderation in wages. That's not something that's going to get the Fed to jump as it relates to changing policy, but it keeps them comfortable with the current policy stance.
On the inflation side of the mandate, that also doesn't seem to be a problem, right? I mean, they want to get down to 2%, and by some measures, they're bang on that.
Right. 2.1% on headline PCE year over year. Exactly. So they're kind of in this position where they can wait and see, which is exactly what they've been communicating. But if I think about the risks, I do think that they're asymmetric towards the risk that we could see weaker growth data, weaker labor market data, particularly relative to what we saw last month. So I look at the job growth data we saw last month, 177,000. Was the job growth created in the April payrolls report. I don't expect that we can maintain that pace of job growth, particularly when I look at things like continuing claims, which continue to trend higher. I look at the Conference Board labor differential. You know, you've seen a rebound in consumer sentiment, but you haven't seen a rebound in some of those specific labor market focused questions. Those continue to show it's kind of a tricky time to be finding a job.
But you do expect then, if you're more concerned about growth, then I imagine you're pricing in cuts for this year.
We do think that later in the year you may see cuts. What I would say is that the risk is that they happen later, but the risk is also that they could do more in the end. So kind of similar to what we saw in 2024, where the Fed held off for a while, and then ultimately they saw the labor market start to slow, and they reacted more aggressively.
So in a vacuum, right, if you told a trader the Fed is going to cut later, you want to own today's debt, right? But we've been seeing bouts of selling in the Treasury market, especially at the long end. And that's on concern about our growing budget deficit. How much of a concern is that? Because, to be honest, we're not at 4.5 on the 10-year. We're not at 5 on the 30-year. Like, the alarm bells aren't ringing right now.
Right, but we were not that long ago, and so I think people are still on edge. So we have been thinking about a range for the 10-year yield this year of 375 to 450, and it was tough when we were up at 450 and we were testing those levels, but it does look like we've settled in a little bit here, and I do think that there is a fair bit of term premium already priced into the long end, reflecting what are real concerns about the deficit. But those, I would say, are generally already priced in. And so I think the risk is a little bit more two-way here. And the question is, what are the catalysts that can get us lower from here? So term premium is elevated. The long end, on a historical basis, valuations look quite attractive. But you need a catalyst to reprice. On the technical side, I think there are some catalysts that we should be watching, particularly as it relates to the debt management offices in the U.S. and also abroad. You look at Japan today; they had a 10-year auction. It went well. Part of the reason it's going well and that things have stabilized a little bit is that the debt management offices there are indicating that they're going to be adjusting their issuance patterns to cut some of that long end supply. I think that is essentially kind of inevitable for the U.S. as well, that they're going to need to start to think about where is the demand on the curve. The demand right now is clearly in the belly and the front end, and how can they adjust their issuance patterns to support where the demand for fixed income really is.
So much for issuing a lot more long-term debt. That's what this administration was complaining about the last administration doing too much at the front end, right?
Right, but we have a different treasury market now, and we have a different curve now. The yield curve was inverted back then. The yield curve is now very steep, and it could continue to steepen. And in that environment, when you're looking at getting the most cost-effective interest costs for the Treasury, you're looking at a different situation now.
All right. So do we see the curve continue to steepen then? I mean, do you see long end demand just not there? And do those yields rise?
I don't think that they necessarily need to rise from here, but that's the risk. I think that the further curve steepening from here probably does need to come from some follow through in terms of expectations of rate cuts. So right now we're in a situation where I think the market is going to persistently, on like a 6-month to 12-month rolling basis, continue to price in some probability of rate cuts. But the base case for most people is going to be that the Fed stays on hold. To get a lot more curve steepening from here, I think it has to come from the growth data actually weakening and the market pricing in a more aggressive rate cutting cycle rather than further increases in the long end.
Not from a buyer's strike, because, clearly international buyers may be offended. And we had a story yesterday that DoubleLine, PIMCO, and TCW are like either not buying or shorting the long end.
Right. I mean, and Bob Michael, the CIO of J.P. Morgan, fixed income, who I work with, was also in that article stating that, we need to be a little bit cautious in the 30-year part of the curve, and that there are some technical signals that we need to see before we really feel comfortable stepping in. But there has been a lot of value created, and it's about what are the fundamental or technical catalysts that are going to get term premium to reprice further from here.
Kelsey, great having you in here. Thanks so much for joining us. Kelsey Berro there from J.P. Morgan Asset Management. Give our best to Bob Michael as well. Let's get a look at what's ahead today. Dollar General earnings coming before the opening bell. Then we get the JOLTS numbers we were talking about, along with factory and durable goods orders at 10 a.m. And Fed speak today from Austin Goolsbee at 12:45 and Lori Logan at 3:30. That's it for Bloomberg Brief. Surveillance is ahead. I'm Matt Miller. This is Bloomberg.